Well, good afternoon, everybody. My name is Rich Harvey. I'll just wait a few more moments till everybody comes in the room. My fellow panelist, Louisa Sanguera, is on her way. She is running a few minutes late, but I will be kicking off the presentation shortly. We had a few technical issues, but we'll be getting through and getting on board very, very soon. So just bear with us and we'll be right there. All right, everybody, we'll get underway. As I said, my name is Rich Harvey, CEO of Property Buyer. Welcome today. Thank you so much for spending some of your lunch hour with us, and we hope you get a lot of great value out of our session today. So, just like to get started, we're going to be talking about a number of things today about upsizing, downsizing, investment property strategies, and also the general mood of the market. Given we've just had another interest rate rise yesterday, what does that mean for you, particularly as a home buyer or a property investor? Now, how can you take advantage of these constantly changing market conditions? So, as I said in the chat, welcome everybody. If you do have any questions, please type them in the Q&A box, and we'll have an extended session, extended Q&A time at the end of this webinar today to answer all of your questions. Also, a recording will be made of this today and available if you want to watch it again, and also the slides and the notes will be sent out to everyone that has registered today. So, great to have you on board. Look, well, let's get into it. Hopefully the screen is all working. So we'll just get going with the next slide. Here we go. So I get asked this question every day of the week, several times over, in fact. Is it the right time to buy a property now? And it's probably the wrong question. In my view, the best time to buy property is simply when you can afford it. When you've got the right financial ability to borrow, and then to actually execute, that is a really good time. Now, obviously, there are certain benefits of timing your entry into the bottom of the market, and maybe if you do sell at the top, but property is a fairly illiquid asset. So holding for a full property cycle or multiple property cycles is what I highly recommend. Um, I've noticed in my own portfolio by holding for, more than 2 decades or even 3 decades, it's incredible the amount of capital growth you get in that second and third decade. Honestly, you just look back and go, wow, that property that I bought for X is now, 3 or 4 times what I paid for it. It's quite amazing. So holding for the long term is generally a better way to go. So what are the main fears at the moment that I'm seeing out there? Obviously, we're seeing interest rates is going up. The Iran conflict and upping the price of oil. So we're basically importing inflation to Australia at the moment. And that's one of the key reasons the RBA decided to pull the trigger yesterday, is that their inflation is getting out of control again. And so we're ending up in a bit of a situation where it is really bad for the economy to continually have high inflation. So they're trying to really put the brakes on with that. Cost of living, not just interest rates, but general cost of living on the price of everything has gone up. So people are more price sensitive. I reckon we're probably going to see at least one more rate rise, maybe a third later in the year. Um, the other thing that's been talked about is the changes to capital gains tax. Now, the CGT has been 50% discount if you hold the asset for more than 12 months. That's been in place for a long time. And the Labor government is trying to address intergenerational equity issues. In my view, this is really going to be a drop in the ocean to affect that. It's really going to cause problems by playing around with the discounting factor. And it's going to basically, again, disincentivize investors from providing housing for the general population. So I think it's a negative policy. I think they should be working a lot more on incentives to improve investing rather than taking it away, and also particularly on the supply side of the equation, which they never seem to get right. Another fear is, what if I buy at the peak? Now, I'll go through some figures in a minute, but Australia is at a very multi-speed market. The good news is that most markets have risen this year. But honestly, we have very, very small troughs and quite large climbs with property. If you go back over the last 40, 50 years of data, you'll see that when we do get a correction or a contraction, it's not very significant. And then the rebound after that period of time is quite substantial, which more than makes up. So you're not catching a falling knife if you're buying in this market in 2026. I've actually written a report, quite an extensive report. Some of you may have read it. And this is called the Australian Property Market Outlook 2025 to 2030. If you want a copy of that, it's available free on our website. You just scan your phone, hold your phone up to the screen, and you can scan it and download it for free. It's about a 70-page report where I've interviewed some of Australia's leading economists, some really great property commentators, and got into the real detail about where I see the market going and where the constriction points are. I've also, in that report, got a number of forecasts on property prices over the next 5 years for each capital city. So my main thesis in that report is that the supply crunch that we think is bad is still coming. We've still got, a major supply shortage as a result of massive migration of 1 million people coming into the country in the 3 years preceding, coming after, what's the name, after COVID. So it's been quite significant in creating supply challenges for Australia. So that's going to underpin the market. So to that point, if we look at some of the data, actually the latest data from CoreLogic here, this is a chart that I regularly put up in my presentations, and I track total listing volumes, national listing volumes, quite closely. And you can see here we're at 17.8% below the 5-year average. So what that means is that there's not enough stock on market. Now, this doesn't apply to every suburb. Some suburbs are more balanced, but the majority of suburbs are undersupplied. And that really underpins prices because we've got the same number of buyers competing for less property. People are holding onto their properties for longer. People are not selling or not moving because of stamp duty imposts. There's a whole bunch of reasons our market is quite locked up, unfortunately. So it's not a fluid market like the share market. So good news if you're a buyer, bad news if you're a renter. So that listing volumes is certainly a metric that we watch very, very closely. The next metric just to look at, obviously, dwelling changes over the past 12 months. As I mentioned, we've seen here quite significant price rises in a lot of the capital cities. So we can see, Perth's done 22%, Brisbane done 17%, Darwin 19%, but even Sydney's done 6%, Adelaide 10%. Melbourne's definitely a market to watch, and I'll talk a bit about that later, but that's definitely in the early stages of recovery. So that's a market that we certainly favour moving into and being a bit more aggressive in to catch the upswing as well. But again, all positive territory there with these. And also the regional markets have done very, very strongly as well, right across the board. So one of the messages I'd like to sort of communicate today, and this might be a bit hard to see on your screens because it's got some pretty small writing, but certainly have a look in the slides that are sent to you. This is a chart by Cotality, or otherwise known as CoreLogic, where they look at all the factors over the last 30 years and the general trajectory of median house prices. So that's a number of things have happened over the years here. So, we can see here, we've had the resources boom. We've had mortgage rates back in 2002 to 2008 rise from about 6% to 9%. We had the APRA play around with the amounts on available to interest-only loans and repricing of loans. They brought in new tightened serviceability buffers, but all of these things, have not derailed the property market. I think the key message is here: policies change, policies come and go, economic shocks come and go, but those that hold property for the long term do very well. So when you buy property, as I say, it's not a short-term time horizon. You need to be looking 7 to 10 years plus, and looking to be holding that property, and particularly buying in the right areas is really critical. I also want to talk about inflation as well, because inflation, as we know, is now sort of above the Reserve Bank range, but property is a massively good hedge against inflation. Anyone that's owned a property for more than 10 years will know how good it's been. So it's just one of those sort of defensive assets that you can have to defeat the inflation genie. What I'd like to move on to briefly now is, I guess, how to build a portfolio, or the three stages of portfolio building. It's just a very simple model I've devised. And when you're starting out, getting your first one or two properties, it's very much a combination of getting the right funding, which Louisa will talk about shortly, and then also getting the right property. So it's making those two things work in unison, the right funding and the right structure for your funding, and then the right asset. So you don't want to buy a property that's going to have really sluggish growth. You want to buy a property that's going to have good capital growth, and then you start recycling that equity into other properties. So let's say you buy a property at $1 million, it grows 10%, you've now got 100 grand, you can then recycle that as your deposit for your next property. And you might say buy a seven or $800,000 property next time. And then you recycle that again on the second one. So every couple of years, you should be looking to revalue, recycle, and reinvest again. And that's how I built my own portfolio, simple rinse and repeat method. Um, and then eventually, once you've got to a certain number, everyone's got a different figure that they want to get to, and that's, very individual thing, then you can start to get toward the top of that pyramid there, where you're looking at rebalancing your portfolio. So maybe paying down some debt, looking to get some more positively yielding or high yielding assets. Maybe you could diversify into commercial or multi-unit dwellings and really start to then get a better yield play, a balance between growth and yield. So early stages should be fundamentally about growth. Then the second phase is about recycling, and then the third phase is about rebalancing. So it's not like it's a set and forget forever. I'm not a believer in never selling a property, but it's not about trading them too quickly that you reduce the upside you get on those properties. Very simple model there. So what are some strategies you can use to get there? Well, I've just listed a couple here. Simply buy and hold for the long term, is a great one where you just simply buy a property. You might do a small reno on it. And we typically recommend to our clients to buy established properties rather than off the plan or house and land packages, which are in typically greenfield or oversupplied areas. It's really important you buy a property in the right location that's got the right fundamental drivers. So strong population growth, diverse employment, good infrastructure, surrounds, good amenities, and good connections to transport. Um, if you really focus purely on cash flow too early on in your investing career, you're really going to, bite your nose to spite your face, and whatever that saying is. It's really about going too low too early. So yes, I do like positive cash flow, absolutely, but not at the sacrifice of capital growth, which does all the heavy lifting in your portfolio. So negative gearing is not a bad thing, but you've got to make sure at some point that the property will start to pay itself off and you can recycle that equity into another property. Granny flats is a great strategy. I've talked about that quite a lot in the past. I use it myself, but it's another way to get additional income and also increase the capital value of a property. And then we move into renovation, building, and developing. And you can see that I've got building and developing on both sides of the equation there, on the risky strategy as well as the smart strategy. So you might be going, hey, Rich, you've done a double up. No, I haven't. The reason I put them in the risky strategy is you need to understand there's much higher risks in doing the building or developing process. I see a lot of wannabe investors or developers come and get themselves unstuck when they try to bite off more than they can chew by doing multi-unit housing or big subdivisions, and they don't have the backing or the equity buffer to manage that process, and then hit snags with council or whatever. So just make sure you get the right advisors around you before you decide those kind of strategies. Also, just another quick comment about NDIS. I know it sounds super attractive when you look at yields at like 10, 14%. The problem I've got with NDIS, it's too specialized for me. I don't touch it because I want to have a property asset that I can flick or sell quickly that's not too niche. It can work for some people, but for me, it's just a too risky strategy. So I prefer to buy great quality located property in blue chip areas that's going to work really, really well. So how do you evaluate which strategy works for you? Well, I've mentioned one of them, which is your risk profile, how long you've got left in your sort of investing time horizon. Another one is how much effort or hassle you're willing to put into it. So, doing development is a big hassle. It's just coordinating a lot of consultants, a lot of trades. It takes up a lot of time. So, if you're short on time, just think about that before you go into any of these strategies. Um, Also, must consider your endpoint. What is your exit strategy when you buy a property? I see a lot of people just jumping in and thinking they're going to get a great property, but in fact, they're not thinking about the exit point. I see particularly for uneducated investors buying house and land packages that have been sold what I call the pup, and then when it comes to selling it, it's hasn't really performed or done very well. So very important to get your exit strategy nailed as well. Yeah, so look at your knowledge, your experience, your time, and really getting clear on your personal goals as to what's going to work for you. So again, here's a little sort of model, if you like, on how to sort of turn 150K as your equity base into a $5 million property portfolio over 10 years. So quite feasible. You start with that 150, invest that into your first property. You're going to be holding that for 10 years, assuming a 7% capital growth rate. And then you buy your second property, again, recycle that equity, then you buy your third property, etc. So it's a simple compounding exercise. So after 10 years, you're going to end up with a portfolio worth certainly well over 5 million just by doing the basic numbers. So it is a bit of a game of maths. It's not rocket science, and that's putting it on pretty simple yields, somewhere between 3.9 to 4.9%. So another question. By the way, Louisa, if you're there, can you please just let me know when you're online? I don't think she's there yet. Um, all right. So next question I get asked is, should I buy now or wait? All right. Should I buy now or wait? Well, to give you a little bit of motivation here, Haswan, who's my head of research and data analytics, I got him to crunch the numbers to say, let's take today's median value for houses in each of the capital cities, and we look back 20 years, and then we looked forward 20 years. So the value of a house in Sydney in 20 years' time could well be $5.6 million. And I hear you roll your eyes and go, wow, Rich, how is that feasible? In Melbourne, it could be 3.5. In Brisbane, it could be 4.1. This is just simply applying the compound annual growth formula of 7.3 or 7.4 or 7.5, as you see there on screen, to the current median price. Now, if we go back, Sydney's median price back in 2005 was, 525. Actually, Domain's figure is actually higher than 1.6. Domain's figure is actually 1.75. So this is totality data. But it's incredible to see the effect of compounding. The next question you're going to say to me is, Rich, how can people afford to buy? If it's going to be that high, that's crazy. So yeah, it's going to be, potentially, 12 to 15 times income to actually afford a house in these capital cities in the future. And that's just what it is. We've seen that in New York, we've seen that in Japan and other international cities like Hong Kong, where it does take that many years to save a deposit to buy an average property. So hopefully that's a bit of motivation for you. And let's have a look at units as well here. So we've got units there in Sydney, current value 903, but could well be 2.2 million in the year 2046. In Melbourne, could be 1.6, Brisbane 2.25. Now, again, this is all based on variable numbers, the compound formula, but again, significant uplift if you hold for that 2-decade period that I'm talking about. All right, let's have a look now at where smart investors are buying. So some of the areas we're recommending, or a bunch of areas we're recommending for our investors. In Sydney, we're recommending Western Sydney areas around, again, the Nancy Bird Airport. They're getting significant benefit. Bankstown, Liverpool, and surrounding centres like Penrith, particularly along the metro train line. The new metro is fantastic. It's really cutting down commute times. It's really significant. Also, we're seeing good value on the northern beaches, eastern suburbs, inner west for lifestyle as well. In Brisbane, we're seeing some significant capital growth, and all our investors that have bought there recently have done quite well. We're still seeing significant growth. And I was talking to Glenn, who's our principal there the other day, and he said, Rich, you could halve the demand for Brisbane property and prices will still keep accelerating. There is just that much demand. We're seeing multiple offers on properties, like property goes on the market on a Saturday, you'll see 7 to 9 offers on it and it's sold, the following week. So pretty competitive, quite challenging to buy there at the moment. Gold Coast as well, pretty competitive. Sunny Coast, also very attractive as well for a lifestyle and investment area. New South Wales Central Coast and also Newcastle, really good areas. We're seeing some good ripple effect of growth, pretty consistent market, the Newcastle market, and decent yields too. We're typically in yields about 4% plus in that market, so strong rental demand going forward. The Perth market has also been very strong performer. Obviously did a massive 20% growth last year. Obviously, I don't believe it's going to do the same going forward. I think it's going to have a rapid slowdown, but again, it's suffering from shortage of supply. So very challenging to get deals again done over there. But again, using buyers agents, we can access a lot of off-market opportunities. Adelaide, that's been a really, under the radar performer, and represents really good value. So your median price is getting close to $1 million down there, but still some really good pockets of value in that Adelaide market. Melbourne is a market I would suggest if you are wanting long-term capital growth to really strongly consider. It's probably the best counter-cyclical play you could make at the moment, just because its median price is about just over 1,050,000 compared to Brisbane at 1.1 and Sydney at 1.75. So it's got a huge gap between the Sydney and Melbourne. Never been that big before. So that's a market that we think is going to perform very, very well over the next 10 years. Yes, there are some political issues with negative taxes against investors, but again, over time, I think they'll be revised. Who knows when? But there's also been a lack of rental properties available. So that's helping to underpin the rental market down there. And then we've also got a number of regional towns that we're also examining. All right, so just a quick, I'm going to get to some case studies in a minute, but I think just quickly cover off how we operate as buyers agents, just briefly. What we do for you is help you identify the right strategy that's going to fit for your budget. We help you identify the right markets to buy in as a second step. And then we start searching and shortlisting suitable properties that we believe meet the investment grade. Once we've found the properties, we evaluate them. We give you estimates on comparable sales, what the rental return will be, crunch the numbers. And then steps 5 and 6, the due diligence and the negotiation phase go hand in hand, where we really protect you from making mistakes. So we check out things like flood zones, subsidence, easements, all of those things you'd expect to make sure you don't make a mistake. And then with the last step, we arrange a property manager and handover as well. So we provide a full range of services, the full search, appraise, negotiate. We can just do appraise and negotiate only. We do auction bidding. We can do vendor advocacy. We can also do property management. Hey, Louisa, welcome. She's fine. We also do property consulting, development acquisitions, and referrals to other professionals as well. Our typical clients, investors, home buyers, prestige buyers, commercial buyers, and self-managed super funds. What does it cost? We send you we work on a fixed fee basis. So for example, a 6 to 700K property is a total fee of around 14K. We charge 3,300 up front and then the balance of the fee on exchange. So it works out roughly 2%, but we have a fixed fee per price bracket. So we send you that if you're interested. And if you are interested in talking more today, for anyone that's on this webinar, I'm willing to do a 15-minute property strategy chat with you. If you are keen to do that, you'd need to grab your phone now, scan that code there, and that will give you a direct link to my diary. I don't regularly do this at all. I'm very reluctant to do this, but my team convinced me, Rich, you're doing a webinar, you should allow them and get some people to have a chat with you. So here it is. I'll give you another 15 seconds, and then we'll move on. So, Louisa, can you hear me okay?
I can, yeah. Can you hear me?
Loud and clear. Great to have you on board. Yeah.
I've been here, but under somebody else's name, but now I'm back in my name.
Oh, good. Great to have you there. I'm just going to go through some more case studies. And by the way, if you need that code again, I can give you that at the end of the webinar today. There's a few other benefits there of using a buyer's agent we'll get to later. So a couple of case studies just to share with you because we want to talk a bit about downsizing and upsizing. So these are some of our recent home buyer clients. As I mentioned, good value in Melbourne at the moment. This was a home we bought in Botanic Ridge in Melbourne. Yeah, saved our client a good bit chunk of money there, but really good value. A four-bedroom house in Melbourne for 860,000. Generous layout, etc. So there's good value compared to Sydney. Same in Brisbane. Something we bought end of last year. Again, saved our client a good chunk of money, but a classic four-bed, two-bath, two-car home in the out near the Springfield area. Again, very high rental demand, but also strong demand from owner occupiers in that market. That's another higher value Brisbane. That was an upgrader that we bought for. Lovely family that wanted to buy in Brizzy. They really wanted the pool for their kids, and we got them a great home with all of that. I think if I lived in Brisbane, I'd be wanting a pool as well. I'd be in there every day. Let's go to a couple on the Central Coast. This was for another lovely family. There's some really good value properties on the Central Coast. Like, once you hit the freeway at Warunga, you're only 30 minutes, basically to Woy Woy or Yamina. So we bought this property, in, I think it was Glendale. 1.2, no, was it? Asking price is 125. We got it for 1146, right near a school. But yeah, really good value there. So if you're sort of squeezed out of the Sydney market, that's certainly one to consider. I do need to share this story where this is a great story for a high net worth upgrader. This is one we bought in Brisbane for a lovely lady that was downsizing to an apartment on the river. Now, she'd seen this particular development, fell in love with the apartment, and was willing to pay the top price. And we said, no, you don't need to pay the top price. Let us negotiate. So we saved her $1.5 million. So Glenn did an incredible job saving that money. That was in Bulimba. So that's the other thing we can do. We can just do an appraise negotiate service. If you've found something, bring us in, hire your gun, and off we go. What else? I've got so many examples to share with you. I'm going to skip through a couple of these. Let me just share this one with you that I did for an a downsizer last year. So I helped a lovely couple that were downsizing from St Ives and they wanted to move to the beaches. So they sold their home and they said, Rich, we just want to be within 10-minute walk of the beach. And they wanted freshwater, Manly or Queenscliff. So I sent out emails to all my agent database, found a great opportunity off market. I saw this property on the Monday. Owners were willing to sell it. They really wanted actually 7 million for it. We appraised it at 6.8. Took my clients through on the Monday, and by Thursday we had it exchanged and negotiated at 6.45. So not only did I save them a huge amount of money, but I was able to get it off market before it went on market, and it would have had serious competition. So this property is directly behind the shops at Freshwater, really close walk to the beach. Clients were just over the moon, and it's only on a small block of land, but that suited them. It had four bedrooms, but on a small block of land, so low maintenance, and really worked for them. Yeah, so we buy properties at all different price ranges, not just the top end or middle end. We buy at all different price points. I'll just give you a couple of other examples of investors, and then I'll hand over to Louisa. We are buying quite a few units for our clients, particularly both home buyer and investor. Getting a foot into the property ladder, and there's some pretty decent yields. So this is one we just bought last month in Waterloo, and we got a yield on this one of 5.93%, which is pretty significant. So there's some good value there in the unit market. Another one we bought there, just for $1 million on the nose, getting 900 a week. Here's another good one we bought on the Central Coast, a nice house here, four-bed house. We got this for 1,065,000, rents for 920 a week, so almost a 4.5% rental yield. So really good performer for the long term. Same thing on the Gold Coast. This was a really lovely unit that our clients bought at Burleigh Heads. Now they're going to turn this into a short-term rental. So that's the long-term rental figure you see there on your screen at 4.91. But we've introduced them to our partner Made Comfy, who does short-term rentals, and we're likely to get a much higher yield once they furnish it and let it out through that other method. So there are other strategies you can use to get the yields up as well. Here's a classic Brisbane property that we bought at the end of last year. This is again another four-bedroom house. We like the four bedders if we can get the client to afford it. It just gives that little bit of extra rental return. And we got that for 935, renting at 795 a week. So that's a really good, strong performer. Look, I've got so many more examples to share with you, but I'm going to just hand over to Louisa. I'll send these out to everybody. You can see I'm skipping through them all. So if you'd like to get in touch, there's my details. I'll be sending across all of these slides along with Louisa's, and I'll just stop sharing my screen. There we are, Louisa. So Louisa, do you want me to bring up your slide deck, or have you got it there ready to go?
I'll just see if I can get it up if you give me 30 seconds.
Sure. If you can't, I can do it for you at this end.
Okay, we'll let you do it at your end then, Rich.
You
That's
can't
it.
get it? Okay, all right. Let me
Yeah, so just to explain, sorry about the technical issues. It always happens when you're just about due to be online on a large webinar. So at 10 past 10, my laptop stopped working. I'm currently on somebody else's Mac, which I'm not used to a Mac either. So
no
sorry
good.
about that.
That's all right. I'll just
While
start
you're getting
sharing.
while you're getting the slides up, I'll just introduce myself to everybody, if that's all right.
Please do. Thank
So,
you.
my name's Louisa Sangera. I've been in finance all my life, really, from leaving school, where I headed into NAB Bank for 30 odd years. I think we put 25 on the slideshow because I don't like to age myself so much. But yeah, I was European Operations Manager for NAB. So in my time in NAB, did lots of lending. I was a branch manager at 21. I was a private manager, commercial manager. I was head of credit. So I've got a big, strong, banking background. And I've been a mortgage broker for 12 years. So
Oops.
we're a team spread around the country, and we do all sorts of lending. Obviously, we do residential loans, but we do love investing. I'm an investor myself. I've got properties in various states. Most of the team are investors. We love investing. It's exciting, and when you can see that it's done well and done right, and the right properties are being purchased, and people are making money. That's a great feeling for us as a team in a business. I know that's the same as you, Rich. Like it's good when you can see the results coming through. So yeah, we love investing, whether it be again property, warehouses, commercial, or whatever. But that's our space. So onto the first slide, just a bit of a market check where we're at on the finance side. Sadly, your borrowing capacity is obviously down right now compared to what it was a couple of years ago. And that is obviously due to interest rates rising. The cash rate yesterday, went up again to 4.1 as expected. And the way things are going, we're probably going to get another. Currently, they're sort of saying one or two further increases this year, but the way the world is right now, who knows? Who knows what's going to happen overnight? We never know from one day to the next. So, I think we all need to be prepared for a couple more minimum. The other thing is that the lenders are obviously applying the buffers. Those rates are currently 3%. So a lot of people do tend to work out the numbers, but they forget to build in the buffer. So when they come to us, sometimes they can be a little bit disappointed because they go, well, I've worked it out and I've got X dollars. And I'll say, yeah, but we need to make sure that if we add on 3%, can you still afford that mortgage? So the banks do that to protect people, just to make sure that they're not overcommitting themselves. Generally, people that own property already are in a good position. Properties, as you've shown in your slides, properties have been going up all around the country. Most people have got equity in the properties, but it is the serviceability that is the bottleneck. We've got people coming to us daily wanting to just refinance, and they can't refinance the loan that they've got because on paper they can't service that now, even though they are making the repayments. They're just not showing on paper that they can service. So some people are stuck with the current lenders at the moment, and the investors. What we've seen, I don't know if you've seen this, Rich, but a lot of investors have been stuck on borrowing capacity.
Mm.
So they've been going more into sort of the self-managed super fund side and trying to buy
Yep.
property in self-managed super. Have you seen that, Rich?
Absolutely. That's a really good point, Louisa. So we've helped a lot more clients in the last 12 or 24 months buying in their self-managed super fund. So a lot of people say, when can you start buying in your SMFS? I would say you probably really need about, say, minimum 250 in there,
Yeah.
and have a buffer of at least 50 left over, because you don't want to be dipping in and having to put a lot of non-concessional contributions in to top it up. So your LVR is probably what, 70 to 80%. You pay a slightly higher rate, but it is worth it because it enables you to get another property. Very excellent tax advantages of buying in your self-managed super fund as well. So definitely worthwhile.
Yeah. We've been doing an awful lot of those on a daily basis this last sort of 18 months. So yes, that's the way investors have been going, but there's still plenty of investors out there that are able to borrow, and there's still plenty of people out there just with owner-occupied properties with lots of equity sat there that they're doing nothing with. They need to be looking at what equity they've got and how can they actually use that to grow the wealth. So many people sat there actually not looking at that. So yeah, interest rates currently, mid fives, I'd say now, after yesterday's rate rise up into the sevens. So, if you're looking at your servicing, be allowing, for it to go up into the sixes, probably. Guys, sorry, I know it's not good news that, but it's the reality.
The reality. Mm.
Yeah. So I wanted to share case studies as well because I think it's nice to see some case studies. So this is a current client actually that is still looking for a property. So they came to us in July 2025 and said to me, definitely not going over 800,000. I want an apartment. It's Lower North Shore in Sydney, but definitely not go over that because, I say to everybody, let's always go for your maximum borrowing that you're prepared to go to, because if we put in for 800 and then you decide to go to 850, we can't just go, hey, can we have a bit of a top up? We have to do a whole new application. So we said it's definitely 800, and we said go and get a buyer's agent. They'll find you the property. What you'll pay them, they'll easily save you on time, money, looking for the property, and on the purchase price, because we see buyers agents as mortgage brokers saving people. I'm not talking 10, 20,000. I'm talking hundreds of thousands even on the bigger properties. But 99% of the time, the saving does pay for the fee. So we're big advocates of buyers agents and have been for years. And I know clients do tend to think, oh, why is Zippy? Why are they pushing buyers agents all the time? I mean, there's no benefit to me at all as a mortgage broker. I'm not being paid for doing it. It's, to me, it's in the client's best interest to go and get that property now rather than in 6 months' time. And just like this client, we started at 800. We're now looking at 1.4 million, months and months later. And we're actually having to borrow off a family and everything to try and get that property. Whereas I know 100%, I'm convinced if a buyer's agent had been involved in July, August last year, they would have been in a property by September. We generally see the people getting properties with BAs 6 to 8 weeks, whereas when they just come to us and we get them approved, we see them sat trying to spend all the weekends looking, weekend after weekend after weekend, and they're literally sat with us. They can be sat with us for a year, 18 months, and we just do read of the pre-approval. In the meantime, the market's running away with them. House prices are going up. The deposit isn't as good. They need more of a deposit. So this is a great example of somebody that started at 800 and is now only, what is it, like 10 months later, we're at 1.4, still
Mm.
trying to buy a property.
Mm. You want me to go to the next one, Louisa?
Please. So this isn't a recent one again. Client was approved for 1.4. But when they went to buy the property at auction, they actually on the day went to 1.57. And it was a relocation loan as well. A relocation loan is a bridging loan. So I got a text that afternoon saying, I've gone to 157. You're going to be able to sort this, aren't you? Which always puts me in panic mode on a Saturday afternoon. Look, I knew they'd got savings, I knew they'd got equity, and I did know that this client had got sufficient servicing. But my message is always go and get approved for the maximum amount. And although you might want to purchase at a certain figure, if you find your dream home and you think that you might go that extra 50, get approved for that extra 50.
Mm.
Um, and try not to go to auction and go over the figure, the agreed
You
figure.
can always go down, but you can't go up with those approvals. And I can't tell
Absolutely.
you enough how another trap for young players, people often turn up at auction not having their deposit in clear funds, thinking they can send it on Tuesday or whenever they feel like it. No, the fall of the hammer, you need to pay on the Saturday. So
Yeah.
make sure your limits are the right number. And they often use Macquarie Auction Pay, so it's directly debited out of your account. So make sure you've got all the funding there in place.
Yeah. And if you haven't got cash, you can get deposit bonds. So
Mm.
you just need to get organized. It's a good point.
Mm.
So the next slide is just to sort of show you how the lenders view you as clients and the different life stages and what they'd expect to see. So your upgraders, if you go in, they're expecting to see you borrowing at your maximum borrowing power. And they're expecting to see you juggling two properties if you're doing bridging and things. Downsizers, they're obviously expecting you to be looking at lower debts, simplifying your lending, and starting to focus on your cash flow for retirement. And investors, the banks won't give you the advice on this, but it is important that you get your structure right. And some bank credit managers may come back and say, oh, the structure's not right. Some may not. Majority of the time it would be a not. They'd still approve it. But obviously, you've got to get your structure right, and the rental income, guys, is treated differently in different banks. So depending on how tight your servicing is, we might need to go to a lender that's perhaps taking more than 80% of your rental income, even though the interest rate's higher, which we often do because, I say to people, if you want the house, you think you're going to make money on that house? And they'll say, yeah. And I said, if you think you're going to make money on it, is it worth paying the extra 0.5%? Is it worth paying the lender's mortgage insurance? I have investors borrowing at 90%, paying the LMI because they want to get that house. They'll make much more money on buying the property than sitting and doing nothing, trying to get down to 80%
So,
LVR.
Louisa, that's a really good point. And I'll just talk about my own example. Early on in my investing career, if when I had a 20% deposit available, I thought, you know what, I was really stingy. I didn't think about wanting to pay that extra 1 or 2% for the LMI. Then I understood the power of leverage. And I thought, my 20%, I can cut it in half and get two properties because my income was okay at the time. So I ended up buying two properties instead of one. And I was very grateful I did that, paid the extra 1%, and it opened up a whole lot of new doors. Mm.
Yeah, yeah, I know. People say to me all the time, oh, when's the right time for me to buy? And I'll say, well, actually 10 years ago, but we're at where we're at. So let's get in the market. It's just get in the market, get in the market. A lot of people procrastinate over investing, or should I do it? Should I do it? You've just got to make the decision and go for it and stand by your decision. I think, I get a lot of people around the 40s, I'd say, they sort of hit that 40 mark and think, oh, what am I going to do with my life? I need to do something. I need to build my wealth. And I just say to them all, yeah, come on, let's use that equity in your owner occupied.
Mm.
If they haven't got an owner occupied, let's just build a portfolio, but it's making the move. And I do think, investing is a lot safer this day and age because of buyer's agents. So I do feel we've got a lot more investors in the market and people do feel safer because they're not having to work out, where do I go and buy a property? Where do I go? I don't know Queensland. I don't know Adelaide. And, what? So now they can just go engage a buyer's agent. It's going to do all the work for them and keep them safe. And hopefully, buy the right property, not just in the right suburb, but on the right street, on the right side of the street. The BA is gonna nail that property. So I'm a lot more comfortable as a mortgage broker seeing people using experts to go and find a property. It gives me comfort. And I've used buyer's agents, for my properties. I don't attempt to do it myself, even though I've got a lot of knowledge as a broker, obviously been in the industry, and I know people like yourself. Time's an issue, and time's an issue for a lot of people. So for the cost, it's minimal. Just let the experts do it. Okay, so upgrade a strategy. So this is a tough one because a lot of people, do come to us and sort of say, "Oh, I don't want to sell my house in case I can't find anything." So what can I do in that sort of situation? And it really depends on the market as to whether you decide to go into sort of a bridging facility or not. If we're in a market where you know that you're going to be selling your property quite quickly, it's almost guaranteed, you could enter into a bridging facility. If you qualify for a bridging facility and you can show the bank that you can service the debt, the end debt with some banks. But if we're in a market where properties aren't really moving, you might be taking a massive risk going into a bridging facility. Me personally, I've always sold to know how much I've got. And the reason I've done that is, like for my last house, where I was wanting to live, I was sort of struggling. Am I going to get a property there or not? It was borderline. Am I going to get what I want or not? If I could get an extra 150,000 or extra 200,000 on my existing property, I knew I could afford there. So I wanted to sell to know exactly how much I'd got before I went and bought. But I sold on a long settlement to give me time. And unfortunately for me, I did make a lot more money. And then I could go and buy the house of my dreams that I wanted in the area I wanted. So it worked out well for me. But I do say to people, be very careful. And a lot of people do sort of say, oh, the house down the street sold for this, but it's a completely different house to what their house is. It doesn't mean to say they're going to get that amount. So you've got to be really clear on the value of your property and what you're actually going to achieve if you're going to enter a bridging facility.
Can I just make one point there too, Louisa? I'm helping some clients at the moment that are looking to buy their owner occupier, and they possibly need to sell one of their investment properties. So we're helping them in the sense that we may have a buyer on our books that could buy that property. So we do what's called vendor advocacy, where we can help the client, and we charge the buyer a fee, so the vendor doesn't end up paying any extra fees. But we can help coordinate that process for the upgrader, for the downside, the same thing. We can help them coordinate that entire process and make it a lot smoother.
Yeah, yeah. But yeah, my point there is just, make sure that you've got your valuation right. You don't want to go using equity that you actually haven't got.
Got it. Yeah. Okay.
Something.
All right, we go to the case study. Yeah.
Yeah. So this one, the upgrader case study. Yeah, this was a nice one. So this was somebody North Shore, similar sort of case study to mine actually, but they were sold for 2.41. So they did get 150,000 more, peak of market. So they did really well. And they were sensible enough to negotiate 120 days settlement, which gives you a lot of time to find a property. But in that time, actually, the market had sort of changed a little bit on the Northern Beaches where they were going. There was a lot more properties came on for sale. And even though the market was probably stronger on North Shore, the Northern Beaches properties weren't moving as fast. And the property that they found was 2.85, but it wasn't selling. It's a double story. And it wasn't your typical Northern Beaches property, shall we say. It was a nice property, but it would fit better on the North Shore than the Northern Beaches. But they loved it. And the old lady that lived in there had an accident and was in hospital, and she was going to have to go into care. So the family were keen to sell it really quickly. And so they got it for 2.65. So it's a great case study of somebody selling at the right time to make money. And by having that long settlement, they took the time, they bought this after 3 months, found the right property, and ended up getting a good purchase. I
Right.
love that one.
Fantastic. Awesome.
Yeah.
All right. Downsizer.
Yeah, downsizers. Obviously, loans are still required to have a full assessment. A lot of downsizers think because they're in the position they're at that they will just get a mortgage and they'll get it easily. But that isn't always the case. So full assessment for downsizers, doesn't matter how asset rich you are or how many properties you've still got to have your cash flow and the income to support a mortgage. Releasing equity, yeah, that is great. A lot of people do release their equity and they might go and see a financial planner and put it into investments, or they'll be releasing equity and put it into property so that they can sit on the property, hold it, make money, cash it in later in life.
Okay. Next one.
Next one.
Hang on. There we go.
Yeah, this is a great case study again. I chose this one because I really love this one. So this was a client, beautiful home, again, Sydney, but beautiful home. They decided that they wanted to change a lifestyle out of Sydney, so they moved more country, got a fabulous house for 1.6. Like it was a big house. I think it was 4 bedrooms, had a bit of a granny flat. And this is only in the last couple of years. So these are, for the last 18 months, this is a good price for a property in the area they bought. And then they went and bought a fabulous apartment in Sydney, overlooking the city and everything. I've been to the apartment, it's stunning, 2.9. So they were getting best of both worlds, country home, city apartment. And I didn't think they needed any money. But they were like, no, when that isn't us done, we're not retired yet. We're now going to buy some investment properties. So these guys have got the dream, country lifestyle, city lifestyle. They come and go as they please. And we're buying investments again. And the plan is to leave those investments and
And how
go
old are these clients, Louisa? Can you tell me?
50s,
If,
50s.
yeah, see, that's a good point. I think, a lot of people think, oh, I get to a point, I'll stop investing. But even 50s or even early 60, you've still got, 10, 20 years runway to make some good money. So
Absolutely.
leverage, it's like, cool. Otherwise, it's dead equity. It's like really, dead equity. You're just not using it. Mm,
Yeah, that's what we call it, dead equity. We see so many people with dead equity doing absolutely nothing to build the
mm,
wealth.
mm.
But yeah, I mean, I'm 59, and I'll be working for, I don't want to stop working. I'm somebody that wants to keep working and working and working because I love it. I love my job.
Exactly. You love
But
helping people. I love it. It's so
yeah,
good.
but I'm still buying property,
Yeah, that's great. Yeah,
So the banks can't be ageist. They're not allowed.
that's it.
All right, so wealth building, lending for investors. Look, it's really, really, I cannot stress, and Rich, I know you'll say the same, I cannot stress how important it is to get your structure right on your property purchases and debt. Now, for your actual structure, because it involves tax, you will have to go and see your accountant. So you need to be discussing with your accountant what the tax advantages are in going into investing and all the rest of it. And then you need to speak to an expert like Rich, what sort of properties you want to go into. Do you want to go into residential? Do you want to go and buy some warehouses? Do you want to go into commercial? So you can look at those and look at the yields and sort of decide on, what sort of properties. But probably before you speak to the BA, you need to know your numbers. So we can run numbers now. We've got a fantastic newish calculator that gives us numbers within 10 minutes across 60 banks. As a rough idea, obviously we're not checking all the information, but we can give you a rough idea of borrowing capacity in 10 minutes now.
Mm.
So we can run that, make sure that you're all right, and then you can start going and looking for your property. But structure is key. the structure of the debt is key as well. I often have people come to me and say, oh, I've got my savings. I'm going to use my savings for the deposit, the investment, and then I'm going to borrow the rest against my house.
Mm.
And I say, no, that's not the way to do it. Obviously you want to be borrowing 100% to get full tax advantages, and let's get the deposit from the house, but let's borrow 80% against that first investment property. And a lot of people forget that they can draw the equity on the investment properties as well. They think they need to keep tapping into the owner occupied. But we can use your investment properties equity as well. So we look at that. That's individual basis. Everybody that comes is different. But yeah, structure, really, really important.
Awesome.
Keep your loans separately as well. A lot of people don't even realize they've been cross collateralized when they've walked in the bank and taken out a mortgage, and then they come to us and we'll go, but you're cross collateralized. And they'll say, what does that mean? And we'll say, well, you've given both properties to the bank and the loans are crossed, and we'll explain what's happened. But if we can, we do try and keep the properties separate. That's just better for us in moving the loans around to keep your loan, the best possible rate we can get. Sometimes if we go to one bank, we can get a cracking deal on, because we are taking, lots of loans to them. So sometimes that's worth it. And, sometimes you might have to cross collateralize. I've actually done it myself. I did cross collateralize a couple of times. Doesn't bother me because I know I am safe. And even if I'm not working or my husband's not working, we know we can afford to pay the mortgages. So for me, it's not an issue. But for a lot of people, it would be an issue. So try and keep your loans separate. And I say we are choosing lenders based on the policies, how they look at investors. Some banks treat people with 3 investments as a professional developer, so the interest rates are higher. You've got to watch the policies in the banks.
Mm.
And when people come to us, we always say, what is your plan? What is your ultimate goal? And I'm sure you do this as well, Rich. Are you looking for that one property, or are you wanting to build a portfolio of 10? Because actually we can look at that now, and that will make a difference as to which bank we go to as well.
Really good point. But it's really important to get that structure right, not just buying one, getting one loan. Really important.
Yeah.
All right, give us a case study here, please.
So this was a couple purchasing investment properties while renting in Sydney. Lovely couple. They just went out buying investment properties. They were renting a beautiful apartment, really happy there, loved the area, couldn't afford to buy there. So, and they did most of the work themselves, a lot of research. They did use buyer's agents for interstate. But yeah, they built a portfolio, and then, 10 years later, sold it, bought the dream house, and actually have got a really small mortgage on the dream house because they'd made cracking money on their investments. And again, I thought they were done. That was it. That was the end of the journey. But nope, they're back and we're going into investing again, which, it makes me smile. I love that they're still, and they're very young. This is a couple in the 30s,
Wonderful. That's so
late
good.
30s. Yeah.
So good. Yeah, cool. We've got another case study here.
Yeah, so this is another interesting one. So no 2 scenarios are the same, are they, Rich? But this was an interesting one. They only had one property actually when I met them, and it wasn't, big value. It was a nice house, but it was West Sydney. It was not, 1.5 million, relatively cheap for Sydney. But I spoke to them about using the debt equity, and you should do something. And she was keen, he wasn't keen. And it took her, I don't know, probably 6 months or something, but they both decided that they wanted to go for it. So they built for an investment portfolio of 4 properties, which wasn't bad going. But where they bought absolutely shot up out towards the airport side, Rich. Absolutely shot up. They made hundreds of thousands. And the female applicant wasn't that happy living where she was living, and she wanted a country lifestyle. So they've sold up. She's packed in work, gone and bought a vineyard in the Hunter. It's only a small vineyard, but she is making wine. She's on a tractor and everything now. She was
Living the dream.
and now she's on a tractor doing her grapes. But they did keep one of the investment properties and they decided to put a granny flat on it. And actually, the husband stays in the granny flat during the week for work because he's got his own business in Sydney, and they rent that one investment out. But
Mm,
a great scenario of how you can achieve so much in
excellent.
such
Yeah,
little time, 8 years.
it's really great. Well done.
Yeah.
That's fantastic. We'll try and sort of speed it up just to wrap it up. So we've got a few more slides, and then we'll do go to Q&A after about another 3 or 4 slides. Yeah.
All right, very quickly then, well, you can look at this slide because we're sending the slides out, but borrow, keep your income stable, keep your living expenses low. Try not to take on a car loan 3 months before you want to come and borrow because it really impacts you. HEX debts are being treated a little bit differently now with some of the lenders, which is giving us more borrowing capacity. And just be aware that the banks aren't generally taking 100% of your rental income, they're taking 80%, and that we've got that buffer.
Excellent. All right. Next one is about timing, optimizing capacity.
Yeah, so just we might need to restructure your existing loans, do different LVRs with them, move them around, split lenders. We'll look at that on an individual basis. We might need to consolidate some liabilities to get rid of them, get them out of the way, or we might just stick them on one of the mortgages. But we're going to search over 60 banks to see who's favourable for you. And, no two people are the same. Depends on your circumstances, depending on the bank's policies. And a lot of the time we do have to remove things like credit limits, unused credit cards, get rid of Afterpay, that sort of thing.
Okay. All right. Timing the move. Okay.
Timing,
Yeah.
yeah. If you're going to change jobs, do it before you come to us. It does happen all the time, that we get a pre-approval and then somebody goes and changes the job. That might mean that you've got to wait another 3 months potentially to get that mortgage approved again. Maternity leave, we do have lenders that will cover maternity leave, but it may impact you. Don't go taking on new debts. Even if you think it's interest free or whatever, it's still going to impact you. Think forward that rate movements are also going to impact you. And the main thing here is, what is the opportunity you've got and what is the cost of waiting?
Yeah.
Borrowing power might be reduced because it is, interest rates are going up. So borrowing power is currently being reduced again. You're already losing out on capital growth. You might be missing a window of opportunity here.
I think the message there is just because rates are going up doesn't mean that capital growth is going to be absent. In fact, there'll be less competition, and a great time to be buying. So yes, it's going to cost you a little bit more to get in, but the upside is far outweighs it.
Yeah. Yeah. Look, last night and this morning, we've had so many emails through. People are actually sort of thinking, I've got to do it now. But yeah, it's your borrowing power is probably still going to be there because interest rates have been this high over the last short period anyway.
Cool. Mm.
All right, 5 questions. This is my checklist. These are the things for people to be looking at. What's your primary goal? You've got to be really clear with what your goals are and what your objectives are. And I know, Rich, you have a strategist in your business that goes through all that as well. And that is key, to set time to work on that. But who are your support team? So I say to everybody, you need a team of good people around you to be supporting you. You need an accountant, you need a broker, you need a buyer's agent, and they're your team. How stable is your income? If your company's not doing that well and you're at risk of losing your job, do you really want to be taking on more debt right now? It's something to think about. What changes in your life are you going to have? You're going to have a child this year, next year. Will you be losing part of that income, but you've got that extra living costs? So, what changes are you going to have? What's your true borrowing capacity? So don't look at what the banks will lend you. What are you comfortable with? Look at what you're paying out now, look at your cash flow, add that mortgage payment in. Is that okay? Is that okay with a 3% increase, or are you going to get yourself into trouble? Because you don't want to be living with the stress of not being able to pay your mortgage in the future. And again, I've mentioned again, what's the cost of waiting? That's always been my big one for years because I
Yeah.
just see people losing out waiting all the time.
Cool. All right.
And
Last one.
yeah, we'll leave that. I mean, how can we help? Obviously, we're going to
Yeah.
run your scenario and see how we can help you.
Right. Awesome. So folks, just please type, there's one question there in the Q&A, but if you've got some questions now, we want to open it up to the audience to just type in your questions and we'd love to answer them. There's Louisa's details too, if you'd like to talk to her and connect with her about getting your pre-approval in place. I can't recommend Louisa's team and Louisa herself enough. She gets excellent reviews and excellent rewards, just like us, for
Mhm.
customer service. So well done, Louisa, for your business.
Thank
And
you.
I think because you take personal care. I think that's the key thing. So well done on that. So yeah.
Thank you.
I'll just take it off the stop share now. Oh, where did the questions go? I had them here a second ago. Where's the Q&A? There we go. Thank you, David, for that comment. Yes, we have been around for more than 10 years. Actually, 25 years. It's coming up for my 25-year anniversary in July this year. So long time as one of the original buyers agents in Australia. Someone anonymous asking, what are the restrictions, conditions to downsizer contributions to super, e.g. age, property type? So again, this is a caveat. I'm not a financial planner, so I'm not licensed to give this advice. But the general rules are that you can, if you are downsizing and you're aged over 55, you can contribute $300,000 each. If there's a couple, it could be 600,000 between the two of you. From the sale proceeds of your property, you downsize a property into your super fund. So it's an additional over and above your non-concessional contributions and concessional contributions. You can make a big lump sum to really boost your super. And I'd highly recommend doing that if anyone is thinking about boosting their super fund. So a couple of things, I used a couple of big words there, concessional, non-concessional, just to explain. You get a $30,000 limit. I think it's going up to 32 next year. $30,000 a year you can put into your super fund at the concessional tax rate, and then you can put into $120,000 extra as non-concessional. Um, so it's really good, in my view, to boost your super, particularly throughout your working career, and really have it as your own nest egg and really look after it. So, yeah, really great way to go. And I'm looking at buying more properties myself, like you, Louisa. I'm not stopping or slowing down anytime soon.
Yeah.
Mm. Louisa, tell me, just while we're waiting on, oh, there's another question coming. Derek is asking, do you have an accounting partner? Yes, I do. So Derek, please just contact me. We've got a number of referral partners that we work for setting up the structure, the self-managed super fund itself, and the bear trust that you'll need to accompany that. So very important to have strong compliance with that.
Yeah.
Quick question, Louisa, for you. What's some of the biggest mistakes people make, or I guess wrong perspectives they have around financing? I think one I see is that people get too fixated on the rate, rather than the borrowing capacity. Mm,
Yeah, no, people do get too fixated on the rate. I mentioned that earlier. It's like, we say all the time, would you sooner pay 0.25 and we can structure you like this, and this? Or you're still going to want that cheap rate because you're going to be restricted.
mm,
Like, in the scheme of this transaction, when you're talking hundreds of thousands or millions, that small percentage doesn't really make a difference. So when we know our people come to us expecting us to find the cheapest rate, and we do our best to find people the cheapest rate every time. But if I can get somebody into two more properties on slightly higher interest rates, I'm always going to have that conversation with the client and try and encourage them to do that. Not all my properties are on 5%,
mm.
Um, you just got to get the structure and pay that little bit
Yeah,
extra.
right. Savita is asking, at age 55 on a single income, is it possible to build a portfolio of properties, noting the bank will lend for 10 years or so? Well, I'll answer that. Absolutely. It's never too late. Age 55, you've still got a strong runway. Yeah, the banks typically will do a 30-year loan, but you can get other shorter term loans. So, Louisa, what's your advice to Savita?
Yeah, as I said earlier, the banks aren't allowed to be ageist, although I will say some of them are. But some banks have got no issues on lending somebody, in the 50s over 30 years. We do have to give them an exit strategy, and we'll work with the clients to come up with that
mm,
exit strategy. If it's investments, generally the banks haven't got an issue with somebody at 55 getting investment. The owner occupied a little bit more difficult at that age, but
mm,
absolutely doable. I had somebody yesterday, she might be on this webinar actually, come for a dad. He's 64 wanting to borrow, and we're doing it.
mm,
So it's
mm,
never too late.
Interesting. Someone's asking here, I have a first home super saver scheme in place, approximately 50K that can be withdrawn. But given the current economy, should I withdraw it? Yeah, so for that one is really a financial planning question, so I'd be
Yeah.
declined to answer that. But all I'd say is that whether you're buying your own home or investment is a personal decision, and you really should be. Some people really want to get in the market really quick, and I encourage them to, but not at the cost of I guess what's the word, being so stressed out making repayments. You do need to get um, enough deposit there. What would you say to that question there? Mm,
Yeah, I'd be referring them to a financial planner to go and get advice. Like you said, we have to stay in our lane and be very careful
mm,
what we say.
mm,
That's an individual. It's your decision. That one, only you can really make that decision.
mm, mm, mm,
People at the minute are asking me, should I fix? Should I fix? Should I fix? You know, I'd love to have a crystal ball and say this is going to happen, but I don't know what's going to happen. Should I be fixing my mortgages? It's
I'll give
like
you my perspective, Louisa. I very, very rarely fix. The only time I fixed was at the bottom of the perfect time, bottom of COVID.
at the
I think I
one.
got a loan at 1.79%. It was
Yeah.
unbelievable. I don't know how I got it.
Interesting.
Unbelievable. Got that for like 3 years.
Because
It was
that,
beautiful.
yeah,
Um,
that's the same as me. I've been borrowing since I was 17. So I bought my
yeah,
first house at 17. I've been variable all my life, apart from when they went down to 1.89. And I thought, you know what? I'm going to fix for that because I'm not a fan of fix, but I fixed for the first time. And it did work out well for me. So
absolutely. So my view is we're going to have this rocky road for a short period of time, whether it's 12 months, at least 12 months, maybe 18, 24 months. And then we're going to get a series of rate cuts to re-kick the economy back into action. Now, as I've mentioned, if you read my report about the great supply crunch coming, you're going to see the market re-accelerate quite quickly because there's this bubbling underlying demand for property right across the country. And I see it turn really fast. So those that have, you know, taken the advice, got into the market earlier are going to be well ahead of that curve. So in terms of fixing, I'm much more a variable guy because I don't want to be stuck at a, 6.5% interest rate on a mortgage when I know it's going to go down to 5%, probably longer term. So 5% is probably the more normal term for a mortgage rate, which is like a three, maybe 5.5%, which is a 3.5% cash rate. So they're the kind of figures that I'd be sort of using as a tipping point whether to fix or not. Mm.
yeah.
Louisa, I think we'll leave it there. We're just about out of time. I just want to say thank you so much for coming on and doing and sharing your expertise with our audience today. Really
Oh,
appreciate
thank you.
it. Mm.
Thank you very much.
And thank you everybody who dialed in today. We really appreciate you coming on board. And as I said, a copy of the recording will be sent out to everyone along with a copy of the slides. If you would like to reach out to Louisa or myself, our contact details will be sent along with the slides. And we'd certainly love to help you on your property journey. But thanks again for joining in, and we wish you well and love to support you. Bye for now.
Thank you.